Hey ladies.
Hey gentlemen.
My name is Stephanie.
My name is Joseph.
And we're from Permission to Be Wealthy. In today's video, we're going to talk about what you can do with $1,000. And this could be either literally something or figuratively something that will pay you dividends. Let's be honest, when we're starting to build our wealth, we all have to start somewhere. And this is one of the number one questions I get from individuals when they're seeking out money coaching.
Awesome, but before we get started, if you're new to our channel is all about open and honest conversations couples should be having about money, building wealth, and hopefully by the end of this video, you give yourself permission to be wealthy. So one thing I think we want to address, Steph, a lot of people that do these type of videos, they do a decent job of telling you how to start investing, but what they don't do is address everybody has a different scenario that they might be in, right? Sure. What type of income they're earning and what level they might be at. Do you want to kind of jump in and have a discussion about what income, if somebody's at a certain level of income, what they might consider doing?
Yeah, I mean, when you're talking about this initial $1,000, income is a consideration. And if you have no income, that $1,000 very well might be something that you absolutely need to feed yourself, keep a roof over your head, pay bills that are absolutely critical and important. And so income is really important. Now, if you are starting with zero income, there are things that you can do, and there's so much information available these days where gaining knowledge can give you the ability of being able to create space for improving a skill that can then give you experience that can allow you to exchange your time out in the market for money, right? So income as one of the first elements of consideration is really important. The other interesting thing about income that I think is also really important is if you are making income, and especially for those of you that are listening that may be in your early parts of your career in your 20s, there's this thing called a 401k, right? Let's go enroll in that and make sure that at a minimum you're investing pre-tax dollars and getting the potential match that your company may be sponsoring and allowing you to benefit from. It would be great to take, your $100 invested in your 401k pre-tax and get another $100 directly from your company to match that and it now be $200, right? So definitely think about the income element, increasing your income if you are starting from a very low space of income. That could be side hustles, whatever, skills, those types of things that you want to acquire. And then take a look at some of the other elements in terms of your compensation, like your 401k, so that you can ensure you're making the most out of those benefits.
So, kind of piggybacking on what you said, essentially, hey, if you're not somebody who has a massive amount of income coming in at the moment, maybe investing into, let's say, individual stocks or something like that might not be the best option for you. It's more so trying to increase your income through your skill set that you're learning. Is that what I'm understanding?
That's exactly right. That's
okay.
Right.
Awesome. So you're at that position, you've increased your income, all right? So we're taking you through this series here, trying to get you to the point of actually making this money to actually invest into something. So you've got money now coming in and you're feeding yourself, you're taking care of yourself, you're paying your bills, all that good stuff. Now the next step on a lot of people's list is actually making sure that you have an emergency fund and savings set aside. So you've made your income and you've got a little bit of money coming in, but now you've got some savings and this, what a lot of people will call making sure you have an emergency fund. And this is important, and we learned a lot through the pandemic, right? So a lot of young people, a lot of old people that were in different scenarios where they didn't have a lot of money to actually set aside to take care of their necessities. And Stephanie, do you want to dive a little bit deeper into making sure you have an emergency fund after you've started making a higher level of income?
Yeah, I mean, if that one stream of income goes away, what might you have to fall back on? That emergency fund is really important. And one interesting statistic that I think you've seen published a bit more after the pandemic is over half of Americans have less than 3 months worth of an emergency fund stashed away. So one way that I like to look at this when I'm coaching individuals is at a minimum, if you look at your monthly expenses and the bare minimum expenses that you absolutely have to account for to live your life, you want to have at least 1 month's worth of expenses in your initial emergency fund. Once you get that established, if you have a stable job, 3 months of living expenses is ideal. So for example, if you're a nurse, we need nurses like crazy out in the market, you're going to find a job, right? So 3 months of living expenses if you have a stable job. And if your job is not as stable, 6 months of living expenses is ideal. And of course, if you have a family and multiple mouths to feed, that type of thing, that's another consideration that you may want to make when determining how much you want to have in your emergency fund. So if you're making that income, like Joseph mentioned in the first part of the video, you're now evaluating your emergency fund and or your savings. Those are the tiers that you can kind of walk yourself through to understand how can you make sure that you have the right safety net to ensure you're not having to rely on high interest debt in the case that you don't have that income coming in.
Awesome. So step one, increase your income if possible. Do anything you can to learn more, gain more knowledge, increase your income. Step two, let's make sure that we're putting aside an emergency fund to protect yourself, protect your family in case of the event that you lose a job or something like the pandemic comes along and just wipes out a ton of jobs, whatever the case may be. Which rolls us into step number three. So step number three is debt. There is a lot of there are several stats that we'll go through here in just a moment, but what I want to say as we look at these steps, you want to make sure that there will be people who will do some of these things out of order, and that's perfectly fine. And I want to make sure we address that as a couple, because there are some things and some people that are out there that may be able to increase their income and start investing, which we'll talk about specific type of investments later on in the video. They may be able to pay their debt off and also do make sure they have an emergency fund all at the same time while they're investing. So we're not saying that you have to do all of these things. We're saying in order to protect yourself at the highest level as you can from a financial standpoint that these things are important. So Steph, if you want to dive a little bit deeper into debt and what those numbers look like, or I guess we're from America, so we'll talk about American numbers specifically.
Sure. So debt, there's two buckets of debt that I want to make sure that we clearly address. There's high interest debt, which is the debt that is literally eating away at any level of gains that you can potentially be making, whether it be in the market and doesn't necessarily benefit you as much. And then there's what we call low interest debt, which is 6% and below, right, in terms of interest rate. Not all debt is bad debt. And in this economy, right, at least now, we'll see what the Fed does as we go through 2022 and what interest rates look like. But when you can borrow or, borrow money at a very low interest rate, taking out debt may not be a horrible thing when it comes to securing maybe your house, right? And a mortgage. But when we're talking about high interest debt, that's something that you absolutely want to evaluate. You need to make sure you're absolutely making those minimum monthly payments on that debt and then identifying ways in which you can pay down that debt faster. And Joseph, there's two methods, right, in which you can approach paying off your debt. There's a Snowball Method and there's an Avalanche Method. Which one do you prefer?
Because we paid off our debt quite differently than everybody else. We went in and we saved a ton of money. I realized how much money we had in savings. We started thinking about investing after reading several books, which we'll link down below. And then we're like, oh, we have a lot of cash, and that's not we're not bragging or anything like that. Trust me, it took us a long time to get there. We're like, let's just start paying stuff off in chunks. So we did it a little bit differently. So Stephanie, I don't have the definitions of snowball effect versus avalanche effect. I don't know if you have those or if you know what they are off the top of your head. I certainly don't know off the top of my head.
Okay, so Snowball Method in terms of paying down your debt and your Avalanche Method. The Avalanche Method is what people say is the most aggressive way of paying off your debt, but it may not give you the feel goods all at once up at front. So let me explain. You're going to take all your debts, you're going to rank them in terms of the highest interest rate and to the lowest. Sometimes the debt with the highest interest rate may not be the most appealing to you to pay off faster, right? But it's going to be the most expensive debt that you need to address first. And so once you start to address making more than the minimum monthly payment across all those debts and putting that extra cash to that top interest one, that's the approach of the Avalanche Method. Because once you really start to address that high interest debt, the one that's hurting you the most, it's really just an avalanche of you being able to really address that debt that's not healthy debt.
So the avalanche approach basically is taking the approach of taking the highest interest. And usually that's probably whenever you say highest interest, that's usually in some cases, depending on what you bought, maybe the most amount of money as well, right?
Correct.
So I guess that kind of makes sense.
But your most expensive in the long term, right? In terms of everything that's all in associated with that debt.
If you're paying the minimums on that, then that's going to add up over time.
That's right. That's right. Then the alternative is the Snowball Method. This is the method that you may want to choose if you really need to stay motivated and seeing progress. I won't say real time, but more steadily and quicker, right? That means you're taking all your debts, you're ranking them from the highest dollar amount to the lowest dollar, or excuse me, no, you're just taking all your debts and you're ranking them from the lowest dollar amount to the highest, and you're getting rid of some of them faster, right? And so the snowball method is kind of this snowball effect where you start smaller and then you keep going and get this bigger snowball effect along the way.
Okay, so each one of those, you're basically chipping the smallest one away. So
Yes.
I guess one of the ways that I've heard it is you're taking the smallest one and you're trying to wipe it away as fast as possible. You're paying your minimums on everything else,
Of course.
and then you're throwing everything extra that you have
Yeah.
from your income at the smallest one to get rid of it. Right?
That's right.
Okay.
That's right.
Awesome. And by the way, whenever you do that, there's something flying around my face here, guys. So I equate that to like gamifying paying off your debt, right? We're all used to playing games. You win little things, and you're like, it becomes a dopamine hit, if you will, and it excites you. And so I think that's why a lot of people actually prefer the snowball effect, because you feel better as you continue to go down the process of paying off these different debts. And we're not telling you which one to go after on how to pay off your debt. It's completely up to you how you choose to approach taking down your debt.
You could even take a combination option, right? Let's say you want to see that progress quickly, and so you choose the snowball method, but when you get your bonus, for example, in the middle part, every quarter, the end of the year, depending on how your pay structure is, you may allocate that large chunk of bonus to what could have been the Avalanche method and that more expensive debt, because you get this quote unquote kind of windfall that you want to address differently, right? Your debt differently. So again, there's not a one size fits all in terms of how you address debt pay down, your emergency fund and how you want to establish it, or quite frankly, how you go about making money. There are so many different ways of, increasing and making income these days. The world is your oyster in terms of how you approach it. The point is you've got to take action and make sure that you're eyes wide open about these three specific things before you think about that $1,000.
Awesome. Well, moving forward now, let's talk about the $1,000. We've talked about increasing our income, building our skill set. We talked about our emergency fund, building that up, and now we talked about getting rid of debt. Now let's move into, hey, we're quote unquote close to debt free, or if not debt free. And so those of you who are ready to take this next step, let's talk about what we should be doing with $1,000, Stefanie, and what would you suggest people start looking at to start investing in whenever they have this $1,000 now available to them?
Yeah, investing in you, right? There are so many, you, me. This is one thing that we did for ourselves, right? And we've talked about this in other videos, but if you are just joining us today, Joseph had been looking at financial independence as a movement and the FIRE movement for quite a long while. And I was very heads down in work and making babies, all these things, right? But in 2020, December, we both decided to read a book together, Quit Like a Millionaire. I have it right here next to me. I'll bring it out a little later. But we read that book together, and I say this is one of the best investments we made together to get on the same page. And it was just a fun read of understanding what the FIRE movement was about and what financial independence could look like, and how you could really make it work for you in the way that your priorities and the way that you wanted to live your life could be. Investing in yourself is so incredibly important, and you can do those things in very, very low cost ways. Books, like I just mentioned, podcasts. If you're subscribed to Spotify today, use that monthly subscription money to the best that you can use it for, because there are tons of amazing podcasts out there, whether they're self-help, financial, personal finance podcasts, things about crypto, new thing in the market. The world is your oyster when it comes to what you can do to invest in yourself. You could pay for a course, right? Be a little wary about what type of course you decide to pay for. I mean, there could be, courses online that are like, you're guaranteed to make $1 million in 6 weeks by doing these 6 things. I don't know about that. I mean, I think my experience so far, and with Joseph as well, it's taken us 14 to 15 years to get to where we are now in building our careers, gaining skills, investing in each other, taking the lead and switching off within, who's doing what in terms of their career and helping with our family. But the bottom line is I think we've invested in ourselves personally along the way and helped each other invest in each other. And it's the best thing we've ever given each other, whether it really costs us money or not. But the thing I want to get across here is investing in yourself does not have to be the full $1,000. It can literally be a fraction of that money that you can allocate the $1,000 to.
Yeah, I agree with that 100%. my thing, if you're going to invest in yourself, if you don't love to read, maybe you love to make money. And not because you love to covet money, but because you love the idea of what money can do for you, which is give you time freedom. And so from my perspective, you can buy a $25 book that can help you become a millionaire. And you can buy 10 of those books, which cost you $250, and read those books and gain that knowledge. People are literally handing out knowledge in these books to help you become a better person, help you become more wealthy, if you just take the time to read and spend that $25. And literally, ladies and gentlemen, 10 pages a day is all you need. So I'm with Stefanie on that. So great points there, Stefanie. So let's go to the second thing that I would do, which is start a business. I would focus on starting a local business. So you've got this knowledge, you know you need to make more money, or maybe you're making plenty of money, but you want to take yourself to another level, right? And you want to say, hey, I need this side hustle, whatever that might be, whether that's driving for Uber, whether that is driving for Lyft or any of these other companies. Starting a local business, right, where you get a team of people who also want to make more money. So you have a lawn care business, you have a cleaning business, a carpet cleaning business, a house cleaning business, a bathroom, a janitorial business. So many businesses that you can get started for very, very little money, and take that and literally increase your income every single month for the rest of your life, and take that money and then start investing. So I think starting a small business would be the second thing you do whenever you, after you've invested in yourself and learned more about money.
Yeah, I mean, most of you watching this video are watching it on a laptop, an iPad, or phone. If you need to purchase some kind of app that helps you build your business, that's an option, right? Right now, at least for Women's Wealth Effect, and this is very much in the infancy of what I'm helping to accomplish to help women, but my spreadsheet of things that I've invested in per se in the business is well under $500 right now, based on the time that I can allocate to the business, and you know where I can really leverage those investments to do what I can do right now. In the future, that could be more, but if I said I had $1,000 to start this business, it'd be well enough to get something really started and see where it takes us.
Awesome. All right, so we're investing ourselves, our knowledge base, right, and growing our mental capacity to understand money better. We're starting small businesses, so this is what we're doing with our $1,000. And number 3, now you're ready, you know enough, you're making enough, you're protected as far as your income is concerned, and having an emergency fund and taking care of your debts. Let's go into actually moving this $1,000 into an actual investment account, and maybe what some should consider investing into. Again, we are not financial advisors, we're not licensed advisors, this is not specific financial advice, this is what we would say to ourselves if we were telling ourselves 2 or 3 years ago, this is what you should probably consider doing, right?
Wish we had a time machine.
That'd be nice.
But yeah, let's talk about the investment part, and we'll start first off with index funds and ETFs. If you've got $1,000, the route that you may want to take or consider is the ETF route. That's the lower cost to entry when it comes to leveraging an ETF. Index funds may be a little bit more expensive. Typically, a brokerage would require that you have about $1,000, maybe sometimes $3,000 to start with a specific index fund. And then from there, you can invest any little amount that you want from there. But an example of an ETF that I have here is VTI. We use Vanguard. I really like Vanguard. It allows us to choose both ETFs and index funds at a very low cost from an expense ratio perspective. I think the expense ratios on our index funds and ETFs that we have selected in our portfolio are about 0.04%, very, very low. If you read online, you'll see that an expense ratio of 1% and below is great. I personally still think 1% is a little high. I like to see the 0.0 something, but that's me, and you know, it's my nerdy Excel brain getting into the mix. But nonetheless, VTI allows you to invest in a basket of companies, the whole entire U.S. stock market. And the U.S. stock market delivers a rate of return about 7 to 8% historically per year. That's not bad, right? And if you look at the most recent years, the stock market's not doing so bad. So Index funds or ETFs are a great way to go when you're taking a look at making your initial investments, but ETFs will be the lower cost to entry option for you.
Yeah, so so I have it pulled up here so everybody can get an idea. So
Awesome.
if you're looking at buying something like a VTI, Stephanie stated there's an expense ratio. The expense ratio essentially is saying, hey, in order to own this particular stock, this is how much it's going to cost you. So some math to look at is for every $100,000 that you have, if this expense ratio is at 0.03, then it's going to cost you about $300 a year. Now, not everybody has $100,000 laying around. So don't worry about the expense ratio so much from that perspective. Now, if it gets too high above 1 plus, then that's a different conversation. But if you have $100,000 and it's growing at a pace of 7 or 8%, the expense ratio is going to be covered, right? So the cost of VTI at the moment today is $235.70, and that can go up, that can go down. We don't know, but what we do know is that in the long term has gone up, right? The stock market again has increased at 7 to 8%. So if you're looking at something that you want to invest in, VTI may be one of those things as far as investing into a broad market or broad stock, if you will. VTI would be something to consider. Again, today it's at $235.70.
Yeah, and hey, let's say the stock market returns 8%. You're going $1,000, 8% return. That's not a lot. But if you address point number 1 at the beginning of our video, increasing your income and making sure that you have a steady stream of income, you could very well continue to invest beyond that initial $1,000 and dollar cost average every single month into an ETF. And 10 years, 15 years, some number of years down the line, you could be headed towards that 6-digit figure in terms of your investments and what Joseph initially mentioned.
Yeah, and I think another thing that we want to make sure that we allow people to understand is, yes, we're going to talk about individual stocks here in a bit, but one thing to keep in mind is whenever we were talking about the S&P 500, you have people who have millions of dollars that pay a hedge fund. A hedge fund is somebody who manages funds for lots of people that have lots of money. Well, majority of hedge funds actually, and I say majority, I'm talking like 90% plus, actually never beat the S&P 500. So you as an individual getting started, it might be the safest thing to do is invest in something like VTI and you hold the top 500 companies. The other great thing about holding something like a VTI is anytime a company is not doing well, there are rotations within VTI managed by Vanguard. Well, they'll take the worst ones out and put newer, better ones in. So you actually, since you're holding this massive, broad basket of stocks, don't have to do anything except buy VTI. They do all the rest behind the scenes. So you always have the best 500 stock or companies within the US that are going to be inside your portfolio by buying one stock, which is VTI.
So index funds, ETFs, very great options, especially when you want to accomplish passive investing. We certainly are, I'm going to call us lazy investors because we are very busy outside of just our investment portfolio, which we'll address in other
Raising
videos.
Kids, doing our own businesses.
That's right.
Yes.
That's right. But it's a great option for you to allocate that $1,000 to. Now we're moving on to the next step, and Joseph mentioned individual stocks, right? This is certainly an option for individuals when it comes to trying to make the most out of volatility in the market. I would even kind of couple this with crypto right now, just with the state of crypto and the opportunity there is on the upside, but also on the downside. We personally don't invest in a lot of individual stocks, and part of that's my anxiety and just not knowing enough and allocating enough time to dive into that. We do have 2 individual stocks that really come from my equity and RSUs from a company, but I certainly didn't choose those on my own. The only thing I would say about individual stock trading is you've got to be very aware of, number 1, the company, the P&L, all the financial details associated to it. You don't want to go make a decision without informing yourself. But the other thing is fees, right? So for every trade that you make, especially if you're day trading individual stocks, you have a fee for buying in on the sell side. So that could certainly eat away at that $1,000 pretty quickly, and I would just highly recommend that you educate yourself on what you're going into all in, both from a fees perspective as well as the risk that you may take on by trading individual stocks.
Yeah, I think one note that everybody should consider is whenever you're looking at individual stocks, if you go look at the 10-year, 20-year cycle of who's at the top of the stock market, because that's typically what people do. They'll go and they're like, okay, let me invest in the top 10 companies, top 20 companies. You will see that the top 10 or 20 companies every 10 or 20 years is not the same companies, which means people who invested in those companies thought they were going to keep skyrocketing for the rest of their lives. That didn't happen, right? And so, from that perspective, none of us can tell what the future is going to hold, right? However, if you look at history of the S&P 500, that 7 to 8% return has been consistent. There will be up years and down years, but if you look at the entire history, the way the chart actually looks, it just goes up and to the right the entire time, right? And I'm not telling you that's going to happen, but that's a lot safer for us to look at than going, okay, is this company like Apple, this company like Google or Alphabet is what it's called now, or Tesla going to continue to increase its profit share and gain in the market? Or is one day, 10 years from now, a decade from now, 20 years from now, it's just going to tank?
Yeah.
We don't know, but what I do know is by holding the S&P 500, we actually hold those stocks in our basket. And if they do tank, guess what? Well, the VTI management Vanguard's actually going to get rid of it and put something else better in. If it skyrockets, guess what? We benefit from that as well. So I think for us at the moment, having that type of investment is just a smarter investment for us. Now, for you, it may be different. You may be able to read stocks all day and read charts all day, and that may be something that you consider today.
I think you just led into something, Joseph, that I want to acknowledge. If you do choose the route of individual stocks and maybe day trading or trading more frequently, if you go all in and really do your due diligence in the research, you may surprise yourself. There are lots of really great courses on having sound investment strategies as it relates to individual stock trading. And I've heard some amazing stories about people that teach really what it means to meaningfully invest and day trade, real time. So if you take that time to invest in a course and maybe take half of that $1,000 and do stock trading, you may learn a lot and you may surprise yourself. So don't hold yourself back if it's something that you really want to do. For us, like Joseph mentioned, it's just not anything that we're doing right now.
Yeah, another note to take away from this as we get ready to end this video, if you can manage $1,000, ladies and gentlemen, you can then learn to manage $10,000 and then $100,000 and then $1 million. But the point here is you want to start managing that first $1,000 and understand what you want to do with that, understand what your end goal is and what you want to accomplish before you actually move into saying, I'm going to be a millionaire one day. You can say that, but you need to learn to manage that $1,000 first. So
we talked about the considerations that you want to consider when it comes to thinking about that first $1,000 and what you want to do with it. You got to have income. You need to address the question and the conversation around your emergency fund. Look at what debts you might have, especially when you're trying to understand what's your high interest debt versus what some of your lower interest debts might be. Then, of course, get into the phases of understanding what you want to do with that $1,000. Invest in yourself. Start a business. You might surprise yourself with some innovative things that you could provide your local community. Look at index funds or ETFs as a passive way of investing for financial independence. And then you can also look at options like individual stock trading or the current hot topic out in the market, cryptocurrency. But the $1,000 is something that could absolutely create the spark that could then start the fire that will help you potentially learn some great things and help you reach financial independence.
Absolutely love it. Well, ladies and gentlemen, this is the end of the video. If you made it here, thank you so much for sticking around and hopefully learning something today. And if you did enjoy the video, make sure you give it a thumbs up, make sure you subscribe, and make today the day you give yourself permission to be wealthy. We'll see you guys.
Bye.